Hi, everyone. Welcome to Cushman Wakefield Asia Pacific Capital Flows webinar with a spotlight on logistics and industrial investment. I'm Catherine Chen, Head of Asia Pacific Capital Markets Research based in Hong Kong, and I will be your host for today. First of all, let's take a look at today's agenda. I will start with a general overview of Asia-Pacific capital flows trends to set the scenes, and then we will have a more in-depth panel discussion on logistics and industrial assets, led by Gordon Marsden, Head of Capital Markets for Asia-Pacific. Gordon is tasked with driving our capital markets strategy around regional clients and institutional investors. Gordon joined us in 2007 and has over 15 years of real estate experience in Asia-Pacific, covering strategic advice, investor relations, capital raising, and brokerage. Joined by Gordon, we have Dennis Yao, Head of Investor Services, Logistics, and Industrial for Asia-Pacific. Based in Singapore, Dennis has over 30 years of experience in industrial and logistic investment, corporate real estate transactions, as well as REIT advisory in Asia-Pacific. We also have Tony Iuliano joining us today. Tony is our Head of Industrial and Logistics for Australia and New Zealand. With 25 years of experience in the property industry, Tony has executed some of the largest industrial transactions ever seen in the Australian market, including the sale of the Milestone portfolio last year, valued at US $2.6 billion. Also joining us today is Stephen Chiu, Managing Director and Co-Head of Capital Markets China. Stephen also joined us in 2007 and has more than 15 years of experience in capital markets in China. With an impressive track record, Stephen has completed several large transactions, including DLJ Greater Shanghai Logistics portfolio. It's also a pleasure to have Hiroyuki Takayama-san from our Japan team joining us today. Hiro leads our cross-border multi-service line projects in Japan and works with top firms to address their corporate real estate needs, covering everything from consultancy to acquisition, disposition, leasing, and portfolio management. Last but not least, Rajesh Jain heads up our logistic and industrial capital markets team in India. Rajesh has a strong investment banking background with over 20 years of experience in real estate business across multiple asset classes and has advised numerous clients, including CapitaLand, ESR, Logos, and GSK on both acquisition and divestment. It's a great pleasure to have our industry experts from multiple geographies joining us today. Now let's take a look at the overall capital markets trends in Asia Pacific this year. It's no surprise that interest rate hikes have been one of the biggest challenges facing investors nowadays. As of June, taking the 10-year government bond rate as a reference, rose to 4% in markets like Hong Kong, Australia, and South Korea, while the commercial real estate lending costs reached as high as 6 to 7%. This has placed tremendous upward pressure on the cap rate and as a result, downward pressure on the asking price. Markets that have been most hit by the interest rate hikes are Hong Kong, Australia, and South Korea, followed by Singapore. In contrast, interest rates dropped in mainland China while remained relatively steady in Japan. As a result of the interest rate differences, investors tend to favor low interest rate markets such as Japan, as well as emerging markets with potentially higher cap rates, such as Southeast Asia and India. The impact of interest rate hikes is reflected on the transaction volume charts on this page. In the first half of this year, overall transaction volume of commercial real estate property in Asia Pacific dropped by 45% year on year. Markets that saw the most significant drop were Australia and South Korea, with the transaction volume down by around 60% year-on-year. In comparison, Japan had a less impact on the transaction volume, down by only 19% year-on-year, whereas some of the Southeast Asia markets, such as Malaysia and Indonesia, which are grouped under the others on the chart, saw investment volume doubling in the first half of this year. On a quarterly basis, transaction volume in Q2 dropped slightly comparing to Q1, although this was based on the preliminary Q2 data from RCA. So we expect the final Q2 transaction volume should be roughly equal to Q1, if not surpassing Q1's volume. South Korea saw a rebound in investment activity in Q2, led by an active office market, as a total of 12 office buildings were transacted in Q2. On the other hand, investment activity in mainland China appeared to remain subdued, although we believe this was partly due to a delay in data collection, as according to our local market data, cities like Shanghai already saw a rebound in Q2, with investment volume increasing by over 100% comparing to Q1. Next, let's take a look at the transaction volume by asset class. Overall, office was still the largest asset class by transaction volume, although the share of investment dropped from 45% last year to only 38% this year, and this was by far the lowest ratio of office investment in over a decade. For comparison, the average ratio of office investment in the last 10 years was at 48%, and now at 38%, it's down by 10%. It's down by 10 percentage points. So where did that 10% go? We found that 5% went to industrial, which increased from a 10-year average of 17% to 22% in the first half of this year. And the other 5% went to apartment, which grew from 4% to 9% currently, while the share of other asset classes remained relatively stable over the years. Nevertheless, as Asia Pacific, as Asia Pacific is such a diverse region, the share of investment by asset class varies greatly by market. As from the chart on your right-hand side, we can tell that the share of office investment was much higher in markets like South Korea, mainland China, Hong Kong, and India, where the office markets were less impacted by working from home. In contrast, share of office investment was the lowest in Australia, where industrial was the largest property sector by transaction volume, followed by retail. In general, industrial was the second largest sector in most markets, except Hong Kong and Singapore, where the supply of industrial land is very limited. Retail investment, on the other hand, was the most significant in Singapore, accounting for over half of the total transaction volume. And this was primarily led by a few large deals bought by Frasers and Link REIT. What's interesting here is the increase of investment in apartment, especially in Hong Kong and Australia, accounting for 16% and 14% respectively. Among the largest deals that were closed, Murdoch partnered with Australian government agency Clean Energy Finance Corp and Japan's Mitsubishi Estate in establishing a $1.2 billion build-to-rent joint venture and had invested in 5 assets across Australia. While Japan remained as the largest multifamily market in Asia Pacific, we saw increasing investor participation in the other markets as well. Since today's focus is on industrial and logistics, if you have any questions on the living sector, please feel free to contact me after the webinar. So now let's take a look. Now let's take a closer look at the L&I market and rental growth across the region. In terms of the transaction volume, we saw a clear rebound in Q2, led by Japan, South Korea, and the emerging markets like Malaysia and Indonesia. Among the largest deal in Japan, GIC bought a multi-asset warehouse portfolio from Blackstone, and Mapletree has also acquired a logistic portfolio from CBRE IM. Generally speaking, foreign investors tend to be the net buyers in Japan, targeting at a value-add strategy. We also saw increasing in international participation in Southeast Asia. For instance, ESR has partnered with Indonesia Investment Authority and MC Urban Development Indonesia and invested in 3 modern logistic parks in Indonesia. Partly driven by China Plus One strategy, we continue to see increasing investor interest in manufacturing and logistic assets in Southeast Asia. In terms of rentals, in general, markets in Australia and India saw the highest rental growth over the last 12 months. Sydney led the pack with a 44% rental growth year-on-year as of Q1, mostly as a result of tight supply and robust tenant demand. In Hyderabad, India, the state government's announcement of logistic policy in 2021 was a big driver of the robust demand seen over the last 18 months. In short, the policy aims at building a logistics infrastructure network by encouraging private sector participation via offering incentives to private investors and startups. Since this announcement, various industrial, pharmaceutical, and e-commerce companies have set up their projects in Hyderabad and helped drive the rental growth. In mature markets, except Australia, rental growth was more modest in the range of 2 to 4%. In general, we saw stronger rental growth for industrial and logistic assets comparing to office and retail. As a major logistics hub, Asia Pacific remains underserved by modern and high quality logistics facilities on the back of growing demand from a rising middle class. The ongoing need for better quality, more ESG-friendly assets in the region will help continue to drive rental growth in the sector. Now let's take a look at cross-border capital flows in Asia Pacific. In terms of investment destination, what stood out from the chart on the left is a clear drop in overseas capital flows into mainland China in Q2, as the market is now predominantly driven by domestic capital on the back of a lower borrowing cost. In contrast, we saw the return of foreign investment in Japan, Australia, and South Korea in Q2, and a jump in overseas investment in emerging markets like Malaysia and Indonesia, mostly in office and industrial assets. In terms of capital source, we saw increasing intra-regional investment within APAC, led by investors from Singapore, Hong Kong, and Japan. On the other hand, investment from the other regions, such as the States and the UK, have now come down. What's interesting here is the rise of outbound investment from Japan, not only in Asia Pacific, but also to the US and Europe as well. Having the benefit of being in a low interest rate environment, some Japanese investors now look for higher spreads in the high yield markets outside Japan, especially when pricing of such investment have now come down. Last slide on investor sentiment. 2 charts are shown here. One is the amount of capital raised by PERE funds with an APAC target. And this also includes global funds with an APAC sleeve, such as Blackstone Real Estate Partner Opportunistic Fund 10, with a global total of $30 billion closed in 2023. What's also included in the bulk of the opportunistic funds raised this year is GAW Gateway Real Estate Fund 7 with a US $2 billion total and a focus on China, India, Japan, and South Korea. Overall, we saw an increasing proportion of opportunistic funds raised this year, targeting at growth sectors. In addition, according to a survey done by Invesco, industrial assets was the most attractive segment for sovereign wealth funds in their real estate investment allocation, both in APAC and globally. New economy sectors in general are also more favored by sovereign wealth funds investors. Comparing Asia Pacific based investors with the other regions, we can see that Asia investors have a more favorable stance towards office assets and less involvement in the healthcare sector, partly due to the lack of investable institutional grade assets in the region. So that wraps up my opening presentation, and I will now hand it over to Gordon to start our panel discussion with the focus on the L&I sector. And to our audience, you may click the Q&A icon on the top right-hand corner of your window to submit your questions. Gordon, over to you.
Thank you very much, Catherine, and good morning, good afternoon, depending upon where you are listening in around the world. So at the top of the webinar, Catherine made introductions of the panelists we have with us today. So welcome Dennis, Tony, Stephen, Hiroyuki and Rajesh. And a really good sort of scene setter from Catherine there over the course of the last few slides. I'd like, if I may, to sort of start with that sort of occupational market. And Sydney there leading the pack in terms of rental growth over the course of the last sort of 12 months, anticipating, and as Catherine mentioned, land supply being pretty constrained in Sydney, and perhaps counting for a little bit of that distinction between Sydney and sort of Melbourne's performance. But maybe I could go to Tony initially and ask him to just sort of unpick that, if you would, a little bit further and elaborate in terms of what you're seeing in the market down there in Australia. Thank you, Tony.
Yeah, thanks, Gordon. So it's an interesting dynamic here in Oz at the moment, especially in New South Wales, because we're seeing the lack of land availability in Sydney for new supply development, which has caused further take up on existing product, pushing vacancy effectively to zero, and as such pushed rents harder in New South Wales over any other state. Now that's kind of an interesting scenario, because that land supply constraint is in relation to planning and a lack of services and infrastructure to allow for the development to occur. Furthermore, the additional unforeseen delays in subsequent holding costs on the land and additional contributions are actually pushing up the delivery costs, which are also being passed on to occupiers from a rent perspective. So we don't see any release in this infrastructure delays in the short term, hence why New South Wales rents, and this is kind of an interesting stat, but if you just go baseline on average, you're well north of $200 a metre, rents, because of the reasons I just suggested in New South Wales. And just broadly speaking, all other states are in a very similar boat, where rents, were what they were, but now they're all averaging at around 120 to 140 a metre in every other state. Queensland, just while I'm talking about land, topography is very similar to New South Wales, and it is also land constrained. So we've seen a significant spike in rents, and we think that'll continue. And Victoria, once again, very similar theme across the country. We expect that rental growth to continue, but the land constraint piece is not as, I suppose, constraint as New South Wales. So overall, our vacancy is very, very low, and tenant demand is still very buoyant.
Thank you, Tony, and great sort of start to proceedings. Maybe I could pivot to Rajesh. So down there in India, we're seeing strong growth coming through, as Catherine mentioned, on the rentals on the occupational side as well. A couple of what I would describe as second tier cities there, but I guess how would you describe them, and also give the audience a little bit of insight into the growing appetite and activity and occupational markets beyond the traditional Mumbai, Delhi and sort of Bangalore. Rajesh, over to you.
Thanks, Gordon. The story, of course, started in 2017 with the implementation of GST and then the warehousing getting an infrastructure status, right? And then, of course, the audacious implementation of infrastructure development to improve connectivity across the country. The key drivers for demand, of course, has always been the focus on. So a lot of these corporates are getting into putting the focus on their core competencies and hence resulting in the outsourcing of warehousing businesses. Of course, flexibility, scalability, and sustainability being other aspects. Now, what has happened typically is a lot of these companies, to safeguard on their capex and opex costs, they have started exploring tier 2 markets as well, which was predominantly looked at by the domestic players in each market. And a large focus is coming primarily from 3PLs and e-com businesses to kind of come on a hub and spoke model to reduce down on the cost, faster deliveries, infrastructure being very, very improved. So just to give you little statistics, the share of warehousing market in 2019 for tier 2 secondary markets were about 11%, which has grown to about 20% last year. Right, which is a significant jump, and most of it, which is about 35%, is driven by 3PL players alone. Having said that, the biggest challenge that is going to come in times to come are the rentals are not going to move significantly up, but the land prices are, right? Hence, that will have a lot of impact on the overall development cost for the players, and that is one of the things which is very, very critical.
Superb. Thank you, Rajesh. Just sort of moving through the hierarchy of rental growth markets, in some respects come next to China, and a positive story, particularly in sort of Beijing, with sort of 10% sort of rental growth, probably amongst the tier 1 cities, Shenzhen aside. We are seeing that positive rental growth sort of story coming through, perhaps allowing investors to underwrite growth sort of once again in that market. You've obviously got a different dynamic going on there as it relates to debt versus most of the rest of the region. I mean, Stephen, can we kind of look forward to a more active logistics and industrial market, and sort of how do you sort of see rental growth moving forward?
Thank you, Gordon. Yes, and China just opened the border, and since February this year, and after the border reopened, the demand for logistics space in tier 1 cities like Beijing, Shanghai, and Shenzhen, and it's very strong demand for this space, and the supply is very limited. So we saw a significant the rental growth there, and also the lending costs in China dropped down, and versus if you're lending US dollar and Hong Kong dollar, the capital cost raised up. So the people trying to get cheap money in China and buying these rental growth properties in China. So that's why the logistics and the industrial projects is chasing by the investors in China. And on the other side, the Chinese capital, the insurance companies, the domestic capitals is increasing their investment attitude and appetite in China, versus the offshore investors may be a little bit conservative at this moment. So I think at this moment, investors, no matter offshore or onshore investors, can be a bit more aggressive on these L&I industries. Yeah.
Superb stuff. And there's probably parallels between China and now India in terms of participation into sort of second tier cities in China. So Rajesh, I think, mentioned that having kind of risen up to around the sort of the 20% level. And from my touch points with the Greater China market, I appreciate that, yeah, activity today perhaps slightly more concentrated towards sort of tier 1 cities, but over the course of the last few years there's also been very significant participation into the tier 2 cities sort of within China as well. I won't ask you at this sort of point, Stephen, to sort of comment on that, but just an observation. Maybe if I could come down to sort of Southeast Asia, we've got Dennis who sits day to day in Singapore. But we've got Dennis on this call to speak both to Singapore and also the broader sort of Southeast Asian market. So just sort of coming back to that sort of occupational piece, that sort of leasing market, what's the state of what is the state of that across sort of Southeast Asia? Is China plus one still playing a role? How's the growth of domestic consumption? Maybe you could talk to some of those topics across Southeast Asia. Thank you. Oh, you've gone on mute, Dennis.
That's the first thing I should do, unmute. Yes. Very, very much the China plus one is very much alive. In fact, with borders opening up after COVID, we're beginning to see more and more China plus one activities across the Southeast Asia market, right? And one have to understand that China plus one is not just limited to MNCs diversifying their supply chain and manufacturing. It is also a China tech manufacturers sourcing and R&D strategy, right? There are curbs on China getting access to some high-tech chips and all that. And this is a strategy for China tech manufacturers, players, to access high-tech chips outside of China, and so you would see Chinese tech companies setting up manufacturing plants, R&D labs in Southeast Asia, including Singapore, right? Another is the development and manufacturing of EVs, electrical vehicles, the batteries and the related parts, so we also see in Korea and Taiwan, the Korean and Taiwanese tech manufacturers, continue to set up plants in Vietnam, particularly Hanoi and Haiphong area, right? So Southeast Asia is a myriad of countries with different labor skills, and different labor costs, infrastructure, logistical efficiencies, and all that. So as a result, the different industries and manufacturing would gravitate toward what best suit their business, right? So be it labor costs, be it availability of skilled labor, fiscal policies and incentives, including infrastructure efficiencies and so on. So, as we begin to see Southeast Asia country, building their strength and fiscal support for certain industries, for example, Vietnam for high-tech manufacturing, F&B, Indonesia for garments, EVs, and related industries, Thailand for EVs, definitely, and related industries, including FMCG, right? And Malaysia for FMCG, etc., etc. So you will be able to see that play out, and this underpin the occupational demand, for Southeast Asia countries.
Superb, Dennis, and not for the conversation today, and we're not joined by Tim Foster, but obviously increasingly involved in that supply chain sort of piece across Asia Pacific and across sort of Southeast Asia. Last but by no means least, with this sort of first question around the sort of the occupational markets and demand drivers. Hiro up there in Japan, what are you seeing there in terms of demand for logistics assets and whether or not that will be sustained as we move forward?
Sure. Well, I think the Japan market is quite unique because as you could see, the rental increase is not that much, but we do see a lot of capitals coming in. Well, what are the reasons? So the demand itself is, I would say, stable, except for the EC volume increase. So what's going on in Japan is mainly because of the change of the types of the property, the warehouse property. Surprisingly, even in Japan, the modern warehouse overall in Japan is only 6%. So we have to change from the old types to modern types of the warehouse. So that's the allocation of the existing old warehouse tenants into the modern the warehouses. Even in the even just look at the greater Tokyo, it's only 15% is the modern warehouse. So that's we can see the potential of the tenants moving to the modern warehouse. Just for information, additional information, Osaka is 9%, Nagoya 5%, Fukuoka 3%. That actually tells how much more we do have a potential for the moving to the modern warehouses. And then also there's a lot of portfolio reshuffling where you mentioned the Tim Foster. So there's a supply chain changes, and also there's a lot of Japanese company holding a portfolio within Japan, but they are trying to shuffle. It doesn't mean not only the consolidation, but they try to increase the existing or the location to make it more efficient to be for the more efficient logistics. Over to you, Gordon.
Thank you, Hiro. Now, as Catherine mentioned, we have a Q&A button, so please drop your questions into there for the panelists. I see a couple there already. They are market specific, around one around sort of China and one also then around sort of Singapore. Please keep those questions sort of coming in, whether or not they be regional or market specific, and we will certainly get back to you if we're not able to address during the call today. I am going to sort of ask my next question rather than specifically address those two questions at this moment in time. If we get a little bit of time later, I'll come back to them. But I kind of want to sort of move the conversation on to, what messages can we pull from Catherine's sort of investment volume slides? So as a sort of little bit of a recap, obviously Asia Pacific down, significantly down on a year back, logistics and industrial down on H1 2022. But we can take some positives certainly from that growth between sort of Q1 and Q2. Obviously towards the end of last year, Q3 2022, we saw a sort of resurgence sort of China as sort of opening up occurred. And that is sort of ticking along, but probably not at this point growing significantly yet in terms of closed transactions, although Catherine made a comment around that. So if you look at sort of Asia Pacific ex China, actually H1 2023 was as strong as the second half of last year. That all would seem to support sort of participation improving, certainly over the course of the last sort of 6 to 9 months. And in the processes that kind of each of you is running in your respective markets alongside colleagues of yours, I hear about day to day this improved participation, which points to stronger volumes in the second half of the year and beyond that. So maybe if we can use that word participation and sort of take me through participation rates in processes in sort of each of your markets. And maybe I could initially come up to China and sort of Stephen, in terms of participation into processes that our business is running up there, what have you kind of seen over the last few months? Are you kind of encouraged by it? I mean, you sort of spoke a little bit earlier on about a bit of further activity from Chinese insurance groups, but yeah, come on, please elaborate further on what you're seeing.
We saw the capital sources is not only from insurance companies and also from the SOEs and also from some private investors, because the lending cost, the key is the lending cost, it dropped down significantly from compared to last year and year before. Now in China, if you're not borrowing money, it's only 3.5 interest rate. It's much cheaper than in Hong Kong, and also
the most of the region apart from Japan. Yeah,
apart from Japan. Yeah, and also the cap rate, the yield is higher than before. The cap rate for like logistics and office. So I think the investors, like domestic investors, they'll get more return than before. And moreover, there's a multiple way for investors to exit in the future. like series in China. There's the government encouraging GOP, ESR, and DME to issue the series and encourage institutional investors and private investors to supporting this series, and also CMBS. Right, so these kind of portfolios and stabilized assets as core assets, it will be more liquidity on the market. So that's it. Yeah.
Thank you. Maybe I could pivot next to Rajesh down in India as another emerging market, strongly emerging market, as to sort of participation into processes that we're running down there in India.
So I think we're seeing a lot of institutional capital following this particular industry class at this point in time. And my understanding is that a lot of institutional capital which was going towards office is now moving towards industrial and logistics, given the growth that's been fueled in. Interest rates, of course, are at all-time high at this point in time for last couple of years. But at the same time, what interestingly happening, Gordon, is because there is no grade A quality asset available in bulk, most of the grade A assets are trading at an all-time low yields at this point in time, right? So let's say if a commercial was trading at about 8.5%, industrial assets are trading anywhere between 7 to 7.25 1-year forward rental values, right? So that clearly shows the kind of demand that is there for grade A assets. The other trend we are seeing in the market right now is on the forward basis. So wherever developers or landowners have got land, a lot of institutional capital is also figuring out if they can do a forward transaction with these landlords or developers and acquire the asset today. However, payments can come over a period of time, which essentially improves their IRRs over a period of time. So these are two common trends that are kind of coming in. And our sense is that probably interest rates will the yields will further drop down, but may not be going below 6.75 in certain quality assets, especially if it's a large portfolio institutional sale that's kind of happening.
Dennis, that question to you.
Yeah, I have to unmute first now. Well, I think participation, continues to be positive, although very selective, right? And then if you start to look into the various countries in Southeast Asia, they are performing at a different matrix, and really, while I say selective, it really means, depending on which country, depending on the asset type, whether it's factory, warehouse, the quality of the asset, the quality of the tenants, the income, any growth potential, and it boils down to what we've discussed earlier, occupational demand, right? In the surface, you will see Singapore attract a lot of interest, because Singapore, we are so land scarce, but then the difficulty about getting logistics and industrial assets in Singapore is really the short lease tenure, right? The short land tenure, and it's all governed by a lot of them, majority of them governed by JTC. So, then you say that well, Singapore really there's lack of assets. There's lack of assets with longer leases. Then you start to go into Vietnam and all that, and the participation level, I would say then, would be really depends on the quality of the asset. What are we talking about here? Are we talking about development, which would give you a better return, or are we talking about vanilla sky, blue chip kind of warehouses, which again is very limited. You will imagine very, very limited in countries like Vietnam, Indonesia, Thailand, and Malaysia, right? So it really depends on the case by case, asset by asset, portfolio by portfolio, and in whichever countries, right? So this would need a whole day of discussion.
So as I come to Hiro and Tony, I'd still fundamentally like you to answer the question around participation, but maybe if I could just sort of frame this a little bit further, as well as on sort of capital sources. So coming perhaps to you first, sort of Tony. So you've done another one since, but congratulations to the team earlier in the year on Axis Corporate Park. That was a bit of a hybrid in terms of asset uses. I spotted a reference in a LinkedIn post, saying that, as a business, we'd identified over 50 billion in capital seeking to be sort of deployed into the sector, as the continued demand and the rental growth that we sort of saw earlier on is expected to sort of persist. Talk a little bit about participation, talk a little bit about, if you are able to do so, the origin of that capital and what sort of capital we're talking about today. Thank you, Tony.
Yeah, thanks, Gordon. A little bit similar to what Dennis just said, but I think Australia now is, as Catherine mentioned in her opening presentation, Australia, probably with Japan, is the most sought after country, and logistics is the #1 sector that most of these groups are after. So the capital that we've identified, which is about 55 billion, is based on bids received and continuously received, but also via our Asia-Pac presentations that we're rolling out through a number of different portfolios. So it's real, it's tangible, and I think, I'll talk about the specific capital in a moment, but based on the transaction that we concluded earlier this week, where we sold a portfolio on behalf of NPS managed by Heitman, that was a bell ringer from a price discovery perspective. So, from an Aussie perspective, everyone knows the thematic about the rent reversion, the land constraint market. That's here to stay for the short to medium term. So, having a significant trade of $500 million basically sets the bar of what the expectation will be moving forward. And I think that's pulled the trigger now of greater participation. So the groups now that are bidding on these types of offerings and smaller assets are the groups that have been going pretty hard over the last 5 or 10 years anyway, across the region. So they're not new. So you're talking about sovereign wealth funds, life insurance groups, pension funds, and because yields are blowing out and you've got the strong reversion story, we're starting to see private equity groups now playing in a big way, because it's starting to tick their return metrics of mid-teen returns. So depending on what the asset is, we're getting multiple participation via LPs, either direct, and super funds, I should say, either direct or via existing relationships through Aussie managers, or establishing new partnerships with new managers. So the participation today is now not coming back to 18 months ago, but it's quite heavy, and it's completely different to what it was when we sold Access Business Park, which you're talking March to July, you're talking a completely different ballgame. So hopefully that answers your question, Gordon. But there's lots going on in Oz, and it's a very, very attractive sector, and multiple participation is back in play.
Good stuff. Excellent to hear. Hiro, you end up with something that's probably a multi-tiered question. Addressing that participation, also on capital sources. I mean, what we saw, obviously, Japan, largest market in each of Q1, Q2, largest destination for cross-border capital, and actually also a spike in Japan as an origin of capital for deployment elsewhere around the region. Share some insights on all of that, and apologies for giving you the multi-tiered question.
No problem. Yes, so let me start from the inbound, the capital coming to Japan, or the transaction happening in Japan. So it's pretty interesting to see the people who's actually investing in Japan, especially focusing on the industrial estate. So the most recent buyer is actually like 50% is the foreigner, and then but versus the seller being the about 60 to 70% for the most recent quarter. It's because, as Catherine mentioned, there's a big transaction for foreigner. So that could happen. I mean, that actually in a way mislead. Or could be the good. It's accurate, but because there's so much big transaction and not many small transaction happening. So one big transaction might give you the big volume for the transaction volume. So that's a participation we see. For more, I get to see more foreign investment coming in, interested in the industrial, but the scarcity of the property for investment is what's happening here. So instead of the existing income generating warehouse, now a lot of people start looking for investment into the development project. So that's where we are. So that means a lot of capital are patient enough to enjoy the income even after the developments. Now, going to the outbound. So the reason why we do see a lot of Japanese company investing outside Japan is, I think this is my personal opinion, but they have been preparing for the investment overseas for past 3 years during COVID. So they already built the team, and then they have been looking for market for such a long time. And then also the fact that we have many different kind of the investors that could be developer, only the investor, and also the we call it the trading company. Maybe you get to hear Mitsubishi Corporation, Marubeni, Itochu. Those are the companies who also do the investment and also development and also the managing. So those are the player having cash ready to invest overseas. And then after this COVID, they were ready. And then that's why it's a lot of transactions happening. I think this trend will follow a couple more years. Back to you, Gordon.
Good stuff. I can see Dennis is multitasking, and in fact what he is doing is replying to one of the questions that's come through around the specifics of the sort of the Singapore market. So thank you, Dennis. There's one there for you, Stephen, as well, if you're also capable of multitasking on China. And if we suddenly lose you, we'll know why you've pressed the wrong button as you've tried to respond to that. We can pick up again on questions sort of offline and circle back with those that are opposing them. If I may move into maybe just a little bit of a quick fire. Give me a threat or a weakness each, and I'm just going to go around as I see you on my screen. Stephen, is there something that kind of keeps you up at night as it relates to the industrial and logistics piece in China? Because it's been mostly positive messages that we've heard so far. So is there a threat or a weakness? And as I say, quick fire, we'll go around the houses on this one and a couple of other quick fire questions.
Thank you, Gordon. I think that we saw a couple of logistic portfolio had been transacted this year. And since last year, we did the DOJ portfolio in China, which is the most successful historically. And this year, we saw some transactions in China, not only the portfolios, and some of the single projects. And in Shenzhen and in Shanghai, and the GOP is buying, and the JD and Jingdong is buying, and also the Ping An Insurance is buying. So there are still a lot of capital in China, and we including the option that GOP's capital is from Middle East, and JD is their own balance sheet, and the Ping An Insurance is their insurance capitals. We saw them buying and transacted, but even the cap rate compared to last year from 4.5% cap rate to maybe 50 to 75 bips higher than before. But I think the assets and the investors still very positive to these assets, to logistics and to industrial. And then also, as Dennis mentioned, the government is trying to build up the infrastructures like the EVs, and the EV is also driving the China's consumptions, especially in the Yangtze River, and the batteries, the cars, Like this morning, we had a news in China. Is Volkswagen invested in Chinese EV company Xiaopeng for 5% shares, which worth more than 1 billion euros. It's very good news, and the European traditional car makers and invest in Chinese new EV companies. So this will also make the Yangtze Rivers warehouse and the factory rental going up.
You've turned a threat and a weakness into a positive by the end of all that. Lovely to see that EV activity is happening. Dennis, a quick threat or weakness around sort of Singapore and Southeast Asia.
I think to me it's really the persistent inflationary environment, to go on for another 12, 18 months, which is actually a reversal of the current trend, right? Where we see inflation is slowing, and if that kind of present to me as a threat, right? Keeps me up at night, in the sense that, with a very persistent inflationary environment, we're gonna result in continuing rate hikes, and being very unstable in that manner. Investors not going to come in, right? It's so difficult to price. It's so difficult to value an acquisition. It's even so difficult to price a divestment, in that sense, right?
Rajesh, maybe something from you.
Gordon, I think for India, every threat is kind of opportunity opening up for new places. Like I was just looking at some reports and realized wherever there is a downfall in warehousing, in some locations, industrial is picked up, right? And that's something which is kind of balancing the demand to supply equation in each of the markets. Now, the only one thread that I really feel that's going to really keep the markets under check would be the land price appreciations, rentals not really improving or not moving as fast as they could have otherwise, putting a lot of pressure on the developers and the investors to keep their returns in check and balances. So I think that's one thing which is there. But at the same time, I'm also seeing trends of markets moving a little ahead from their existing markets, right? Which is where the land prices are slightly better off. Rentals, of course, get lower in that belt, but it at least helps the players to kind of maintain a good investment history alongside, right? So, but yeah, as I said, every threat in India is kind of becoming more and more opportunistic in nature, and which is the good part of it, yeah.
By this point, the audience and also my panelists knows that I quite like my multi-tiered questions. So, Tony, maybe pick up on that threat or weakness, but also, I guess, sort of a changing dynamic that we're sort of seeing within all markets across Asia Pacific, but probably being led by Australia and perhaps Singapore, is around the sort of the sustainability side of things. And obviously, I would sort of say, a lot of product is new build, and therefore, there are some obvious sustainability measures that you're able to sort of incorporate. But that sort of dynamic is probably a little bit more challenged as it relates to sort of existing sort of product in the market. So maybe you could sort of address if there is a threat in the market to you today, but also a little bit around that changing regulatory kind of environment and how groups and investors are sort of thinking about the sustainability piece, because I suspect that's pretty front of mind.
Yeah, just on the sustainability piece, Gordon, this is obviously driven by capital requirements and obviously world authority. So I think from how do you make a nice shed into an absolutely gorgeous shed? There's a couple of measures. I think Australia's leading the way, from that perspective. My 5-star Green Star, whether you put solar on the roof and grey water and all these sorts of things, I think that's kind of the norm now, and then you've got the older facilities that you need to not spend a lot of money, but there is an impost or cost to repurpose older facilities, and that'll flow through the system within time. But for managers that want to get capital and manage large portfolios, that will be a requirement. So they need to have that expertise to execute on that task. Positives and negatives, Gordon. There's no negatives. The positives are, as an advisor, when there's times of volatility, providing that strategic advice that adds value to the customer is very, very important and high on our agenda, and that's really our focus. And having been through, 2 or 3 ups and downs, from a recession or disruptions, I think having a safe pair of hands is very, very important in the current climate. But it's all positive.
Good stuff. Hero, threat or weakness?
Sure. Yeah, so I think the threat, the weakness in Japan is actually pretty liquidity, because although there's property and attention or the interest to Japanese market for industrial, but there aren't many coming in. As also mentioned in the beginning, there aren't many good warehouse investment opportunity, being that only 15% or only 6% of the modern warehouse. So that's, although there's a lot of development happening throughout Japan, but I think the speed of the development versus the capital interest might not tag along much. And then if the redevelopment delays, and then I think all the capital goes to the other sectors. That's what I think it's a threat or the weakness in Japan.
Understood. Dennis, question just around Catherine's comments around increasing investment in Southeast Asia, especially Malaysia, office industrial, Indonesia, mostly industrial. We're also very conscious that our Vietnam team is very active in this industrial logistics space as well. Just try and give us a quick wrap up on sort of Southeast Asia, if you would.
Yes, Southeast Asia, we must understand that it's a mosaic of opportunities, right? It's a symphony of growth, right? So when I say that, it means that, different parts of Southeast Asia, they have their growth story, they have their opportunistic assets, that you can invest in and all that. And it's also, Southeast Asia is really undersupplied for modern warehousing. And we've touched on that, as well as high-tech manufacturing, right? So it's first most important to first understand the occupational demand. That's why we started this discussion really on where the occupational demand for logistics and industrial assets, right? And before embarking on capital investments, whether it's investment in developments or investment in acquisition of completed buildings, I would say now is a good time to invest, as we actually have less capital competing for quality real assets and developments. Right.
And a cap rate in Singapore today?
For industrial logistics, really because of very, very short land leases, we are still hovering at about 7%.
Okay, so 7% Singapore. India, we heard earlier on at 7.25%. China at 5.25%. Hero, a number for Japan?
Yeah, it's about mid-3 to mid-4. Let's say around 4.
And Tony, what are you going to deliver on your next portfolio?
I better not comment because I might undersell it.
So I must qualify that for Singapore is really due to the very short land lease. I mean, with longer leases, land leases, as well as some of the freehold properties, we are talking down to 3-4%.
Stuff. Well, as you can hear, audience, there is an awful lot that is happening around the Asia Pacific region, and even evolving requirements, activity, depth of sort of participation. So I hope that you have enjoyed this session today. Apologies if we've not been able to get to all of your questions. A recording of this webinar will be made available to those sort of participating today. And if I may, I'll just finish off by saying a big thank you to all of my colleagues participating, Stephen in China, Dennis in Singapore for Southeast Asia, Rajesh down in India, Tony for Australia and New Zealand, and Hiro up there in Japan. We were kicked off today by a very insightful presentation from Catherine, and I'd also like to extend my thanks to Catherine. Keep well, everybody, and we look forward to connecting with you and further exploring this asset class over the course of the coming weeks and months. Thank you very much.
Thank you.